Hello. My hair looks a little messy today. Jeez. Wow. We're live everywhere. The only problem is that does not appear over there, which is a significant problem for me. Can I pop this chat out? Pop out. Wow. Rhodesia. Rhodesia. Can I moderate you? Okay. I'm going to assume it's good. We're doing it, guys. Guys, there's a lot going on today. There's so much going on. Genuinely. Good lord. Hey, I've been streaming for a long time. I think I understand how that works. Thanks. It's been a long time. Okay, I think I'm mostly set, which is crazy. Crazy. God, I'm so glad I waited to cover the story. To finish what we started, a nearly 50% premium. We're gonna start off the stream by playing Sudoku, however, because this has been a lot of fun recently. Okay. My Williams hat. Hey, caramba. Anyway, we'll get there eventually. How does this work? Whoa. Oh. That's neat. So this has to be a 3. So this has to be a 3. I know this is the content we all came here for. This has to be a 3. So this has to be 4. And that's the only 4 on the board. Never mind. Excuse me, Mr. Finance Streamer. This doesn't appear to be finance content. It's true. It's true. You got me. This isn't finance content. I lied. I was never a finance streamer to begin with. It was all a ruse to get you to watch Sudoku. It's true. Are there any more easy numbers to get? Yes, 5. That means either of these could be 5. This has to be 2. Very cool. Let's go back to 3. Oh, 3 has to be right here. Right? Yeah. There's no other option. Ain't got no options. That means 3 can go either here, here, or here, or here, which is not great. I'm not in my prime Sudoku playing era anymore. 9 has to go here. That means it has to go here. So the 9s are solved. 7 and 8. So this has to be a 7. This has to be an 8. Because that finishes that. And then that means this has to be an 8. Wow. Guys, we're doing it. No easy 4s. How about 1s? Haven't even looked at the 1s. 1. Easy. Easy. Could be either one of these. But this can't be. And all of a sudden, all the 1s are gone. Amazing. 2. 2, 2. Yo, this game is easy. Oh, so this has to be 4. Nope. This has to be 5. That means this has to be 5. I seem to have gotten myself in a bit of a predicament. Tragically enough. But we shall press on. Oh, look at that. Terrible. There's only one spot for a 5 left, and I can't place it. Yikes. I'm thinking almost everything else is correct, though. I've discovered my problem. I'm thinking it's this. Well. Well. Tragic, brother. Do we restart? It's been 6 minutes. Show errors. Oh, Lord. Um, that has to be 9. It can't be. This literally can't be anywhere else. Okay, we figured out the 9s. So these can be 6s. These can be 6s. I think I was right in my assumption there. I think I was right. My 2s. Literally can't be anything else. Okay, we're going to relax. We're going to go to 5. Oh, wait, I can solve this. 1, 2, 3, 4, 5, 6, 7. Wow. Literally can't be anything else. Literally can't be anything else. Literally can't be anything else. And the 7s are done. Very cool. Literally can't be anything else. Literally can't be anything else. So 1. I'm missing a 2. I'm missing I got a 1. I'm missing a 2. Got a 3. I'm missing a 4. Oh, wait. Can't be anything else. That means this solves this, and this solves this all the way around. Amazing. Five, incredible. Wait a second. That can't be right. 1, 2, 3, 4, 5, 6, 7, 8. This doesn't have an 8. 8. I feel like we're going to run into the same problem we just had. Three, 4. So this has to be 5. Which is a problem. No, it's not. Easy. That means there's only one other place for 5, which is right there. Oh, it's fixed. I fixed it. Literally no other place. Literally no other place. And literally no other place. And everything else falls beautifully. 8. Don't know what that is. 1, 2. This must be a 3. 1, 2, 3. This must be a 4. 1, 2. 1, 2, 3. This must be a 4. 1, 2, 3, 4, 5, 6, 7, 8, 9. 1, 2, 3. This must be a 4. 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 This must be a 3. This must be a 3. 1, 2. This must be a 3. This must be a 3. This must be a 3. And this must be an 8 and an 8. Wow. We solved it even faster. Amazing. Amazing. Oh, right. I forgot. Yeah, listen. Calm down. I get it. I get it. I actually have no idea how to stream on. No, not yet. Oh, upload a thumbnail. Guys, I found it. Okay. Amazing. We did it in 5 minutes and 12 seconds because we're literally the best. There's nobody better than us. Let's see how my stonks are doing. Where's CCRN? Why is CCRN not on here? I'm losing a lot of money on that stock. It's down 1%. Tragic. My portfolio is terrible. Bro, Path is up another 5%. It's $20 a share? God, day. That's insane. Intel? Actually, let's look at the big stuff. What's happening across the market? Google's down 1. Nvidia's up 1.5. Microsoft's up 1.5. Netflix is down 3%. Brother, we're going to get into that. This is going to be great, I think. I am very excited. Personally. Oh, hey, I actually have this right here. There's a really funny. I wish I had a screenshot of it. Maybe I'll try and find the actual screenshot of it later. But there was a hilarious. There's an absolutely hilarious. Oh man, what was it? It was a hilarious tweet that I saw this morning that was like, a bunch of really big kind of pseudo-anonymous investor guys on Twitter were like basically making fun of some guy who lost 50% of his retirement account portfolio in like a month. And I just think that's amazing. A truly incredible moment. Google's a massive. Actually, I'm going to see if I can find that real quick because I think that'd be so funny. Yeah, we'll. So we're gonna actually we're just gonna get into Netflix. That's what we're gonna do. We're gonna get into Netflix because, good Lord, this story. I'm so glad I waited a couple of days to cover this story because, good Lord, is it amazing now. Netflix to acquire Warner Brothers following the separation of Discovery Global for a total enterprise value of almost $83 billion with an equity value of $72 billion. Amazing. Basically, Netflix came out and said, hey, we would like to purchase all of Warner Brothers except for Discovery. And we're going to wait until Warner Brothers divests from Discovery, because if you didn't know, Warner Brothers a little while ago announced that they were going to separate. Warner Brothers Discovery, which is a spin-off from AT&T, announced that they were going to separate into two separate companies. They were going to get rid of their streaming and their studios. They were going to separate their streaming from their studios. And so you would have sort of like a pure play streamer and a pure play studio movie maker. It's great. Amazing. And so Netflix only wants the streaming bits, I believe. All the studios, they don't care for. Actually. Or are they only buying the studio bits? Warner Brothers. Oh, okay. So Netflix is buying the studios. Netflix is buying the studios, but they're tossing and they do not want the streaming bits, which I guess makes sense. So they're only adding the libraries from HBO and HBO Max. Yeah, studio capabilities along the company. Yeah. So they're buying the studios. They're leaving out the streaming bits. I'm gonna go buy me a Midas Touch streaming board. Anyway, enhanced strategic focus and flexibility would better position storied brands across entertainment, sports, and news to drive shareholder value. Streaming and studios company will consist of Warner Brothers Television, and then global networks will include Premier Entertainment, Sports, and okay. All right. We're learning. This is a learning stream. This is the stream that you come to actually learn, because I'm learning too. So Warner Brothers is separating into streaming and studios, which is what Netflix is buying, and they're splitting into global networks, which includes CNN, TNT Sports, US, and Discovery, which is basically all the profitable stuff. Everything else is unprofitable for the most part. David Zaslav, and he will serve as president and CEO of the global networks, as opposed to. Oh no, the CFO is taking over the CEO spot at Global Networks. What? Why? Seems like a terrible idea. The cultural significance of the great company, yeah, great. Hey, remember when AT&T bought Time Warner, for $100 billion? It only took them 25 years to get back there. So Netflix, all right, we're going to go back. Netflix is acquiring Warner Brothers Discovery. They're only requiring the studios and streaming bits. There's a whole other separate section of the company that is sort of the mainline networks. So that includes things like CNN, TNT Sports, US, and Discovery. Amazing stuff. Oh, and they're actually divesting Discovery Plus too. Interesting. So not all the streaming services, just the ones that are good. Samuel A. Di Piazza. Name in Italian, I guess. Samuel A. Di Piazza Jr. Okay. So, like I said, Netflix threw out a bid $27.75 per share of Warner Brothers Discovery. Currently, Warner Brothers Discovery, let's especially with today's news, let's check it out. Currently, the stock is trading at $68 billion. And or $27.78 a share. And the reason why they're trading at a higher share price is because this morning Paramount, which is a company owned by the Ellisons, Larry Ellison specifically of Oracle fame, has launched a $108.4 billion counterbid for Warner Brothers Discovery. The streaming giant had emerged victorious on Friday from a weeks-long bidding war with Paramount and Comcast, securing a $72 billion equity deal for Warner Brothers Discovery TV, film studios, and streaming assets. This offer, which is worth $82.7 billion including debt and comes with a $5.8 billion breakup fee from Netflix, which is insanity, is likely to face strong antitrust scrutiny, which we'll talk about that in a second. Paramount submitted multiple offers starting in September to forge an entertainment powerhouse capable of challenging Netflix and tech giants such as Apple that have expanded into media but faced rejections. It is offered to buy the whole company at $30 per share compared to Netflix's nearly $27.75 per share for its assets. Paramount remains one of Hollywood's major studios, but its box office record has been uneven. Netflix is down even more today, 3.5%. That followed reports that Warner Brothers management called the Netflix deal a slam dunk while speaking negatively about Paramount's offer. Analysts and industry experts see Paramount as the best candidate for acquiring Warner Brothers Discovery, given Ellison's deep pockets. And the person that runs Discovery, the person that runs Paramount is Larry Ellison's son. Larry Ellison is this Oracle guy. Ellison's son runs Paramount. Shocker. I want to actually look at. I wish there was a way that I could see the actual $108 billion. Like, what does the deal actually entail? I wonder if Paramount acquisition offer. Let's see if I can find it. Yes. All cash? All cash? Paramount launches all cash tender offer to acquire Warner Brothers? Okay, never mind. This is December 8th. That's today. Offering, golly day. Offer provides superior. Hang on. Offer provides superior value and a far more certain and quicker path to completion to WBD shareholders. Equity to be backstopped by Ellison family and Redbird Capital, in addition to debt fully committed by Bank of America, Citi, and Apollo. Obligation to take offer to WBD shareholders over concerns that they are not presented most compelling and superior transaction. Netflix transaction provides WBD shareholders with an inferior and uncertain value, a protracted and uncertain multi-jurisdictional regulatory clearance process, a complex and volatile mix of equity and cash. This is not true. This is a lie. It's not complex. Netflix didn't offer like a portion of their share. They said you get this much in cash and then you get exactly this much per share. They didn't offer like 0.01% of a Netflix share, which is something that a lot of companies will do when they go and they. So, hey, listen, I mention it all the time, but it's a really relevant example. So, Kimberly-Clark offered to buy Kenvue a couple of months ago now. Actually, it was like a month ago. And Kenvue basically said, sure, we could do that. But Kimberly Clark offered the majority in cash, but then they also offered a percentage of a share. So you get like 0.35 of a Kimberly Clark share and whatever else is in cash. But Netflix's deal is not like you get 0.1 share of a Netflix. Netflix is like you get $23.25 and then you get $4.50 of a share, no matter what the share price is. So this is a bit misleading. Mix of equity, complex and volatile. It's not complex. It's not really that volatile either. And ownership of Global Networks as a standalone over-leveraged company whose future trading value is uncertain. We're going to get into something really interesting in a minute, a really interesting theory as to what's actually going on here, which I tend to agree with. Paramount, a Skydance corporation, today announced it has commenced an all-cash tender offer to acquire all the outstanding shares of Warner Bros. Discovery for $30 per share in cash. Paramount's proposed transaction is for the entirety of Warner Bros. Discovery, including the Global Networks segment, which is interesting. Well, obviously. So Netflix just wants to buy the streaming and studios assets of Warner Brothers Discovery, and then they want to get rid of the networks. Paramount is offering to buy the whole company and to buy it immediately. They want to close this transaction quickly, like Q1 of next year. David Ellison, chairman and CEO of Paramount, said WBD shareholders deserve an opportunity to consider our superior all-cash offer for their shares in the entire company. Our public offer, which is the same terms we provided to the Warner Bros. Discovery Board of Directors in private, interesting, provides superior value and a more certain and quicker path to completion. Okay, so Warner Brothers Discovery already got this offer. They already got this offer in private. Paramount's just making it public now. Where they're like, hey, why not go with us, you know? Paramount is highly confident in achieving expeditious regulatory clearance, I wonder why, for its proposed offer as it enhances competition and is pro-consumer, while creating a strong champion for creative talent and consumer choice. In contrast, the Netflix transaction is predicated on the unrealistic assumption that its anti-competitive combination with WBD would entrench its monopoly with a 43% share of global subscription video on demand subscribers and withstand multiple protracted regulatory challenges across the world. In many European Union countries, the Netflix transaction would combine the dominant SVOD player with a number 2 or strong number 3 competitor. The Netflix transaction creates a clear risk of higher prices for consumers, obviously, lower pay for content creators and talent, and destruction of American and international theatrical exhibitors. Netflix has never undertaken large-scale acquisitions, resulting in increased execution risk, which WBD shareholders would have to endure. Paramount, on the other hand, makes acquisitions all the time. Skydance, for instance. Actually, let's see what's happening with their stock. Up 3.5. Up 3.5. $15 billion. Wait a minute. Wait a second. Paramount, a $15 billion company, is offering to buy Warner Brothers Discovery for $100 billion. Something right here, I think. Actually, that's insanity. I just want to see one. I just want to see how much cash Paramount actually has on their books. Assets, current assets. They have $3.3 billion in cash. Paramount has $3.3 billion in cash, and they're offering to buy Paramount, a $15 billion company with $3 billion in cash, is offering to buy Warner Brothers Discovery, a $100 billion company, in all cash. Okay. Why do we think this is? Okay, so I read a really interesting theory. I'm going to read it on stream too. This is the Dre dossier. I've never encountered this. I have no idea what their political opinions are. I do not explicitly endorse this person. However, this is interesting to me. It is an interesting theory. The day Larry Ellison lost and won, what really happened at Warner Brothers? Okay. If you've been anywhere near Hollywood this week, you know the vibe. Netflix buying Warner Brothers is the only thing anyone's talking about. Obviously. It's a big deal. Emergency podcasts, group chats on fire, think pieces about what it means for theatrical, for HBO, for everything. Netflix acquiring one of the oldest studios in Hollywood is huge, but here's why I can't stop thinking about it. While everyone's focused on what Netflix is buying, nobody's paying attention to what they're not buying, something we talked about, and who's positioned to pick up those pieces. Because on December 4th, the day before Netflix's big win got announced, one of my Google alerts went off. Larry Ellison's net worth had just surged $5.2 billion in a single day. Actually, Oracle is up. Oracle is up 10%. The vast majority of Larry Ellison's wealth is tied up in Oracle stock, and they're up 10% since this deal sort of started to happen, which is very interesting. And honestly, it makes me think that this is what's going on. One day before he publicly lost Warner Brothers, the man got $5.2 billion richer. The Oracle rally traced back to December 1st. That's when Deutsche Bank reiterated its buy rating on the stock, calling it an attractive entry point given recent weakness. Except Oracle has been sluggish for months. No earnings surprise that week, no major contracts, nothing that would make a bank suddenly remind everyone Oracle's a buy. And yet, Deutsche Bank picked December 1st, the exact day final bids were due in the Warner Brothers Discovery auction. Analyst upgrades typically take 3 to 4 trading days to translate into wealth gains for major shareholders, which means a December 1st call would predictably land on Ellison's net worth on December 4th. I don't know if that's exactly true. However, the timing feels coordinated. Okay. I watched the Paramount-Skydance merger closely in 2024. Larry Ellison's been on my radar for a while, and when his son was acquiring Paramount, I wanted to understand exactly how they structured it. So I made a spreadsheet of all their special vehicle holdings. Yes, I am that person. Pinnacle Media Ventures 1, 2, and 3. I tracked every special purpose vehicle they used. If they want to understand how billionaires move, you don't watch what they say, you watch what they file. 3 entities stood out. All filed on the same day, June 28th, 2024. 9 days later, the Paramount Skydance deal was announced. Pinnacle Media Ventures is the umbrella structure Larry Ellison creates with LLCs beneath them for David's direct investments. So Larry Ellison is going out and creating special purpose vehicles that he is using to fund his son's media empire, basically. So I figured if the Ellisons were planning to acquire Warner Brothers, they'd probably use the same structure. They aren't exactly creative with their naming conventions. I pull up the Delaware corporate database, typed in Pinnacle Media Ventures, and what do you know? Pinnacle Media Ventures number 4 filed on December 1st of 2025. The same day, final bids were due. Also the same day, Deutsche Bank upgraded Oracle. Very convenient. Because these two things suggest opposite conclusions, filing a new acquisition entity suggests confidence. You don't create that infrastructure unless you're expecting to use it. But if they already knew they were losing Warner Brothers, why file it at all? Unless Pinnacle Media Ventures 4 isn't for Warner Brothers, unless it's for something else. This question made me look at what Netflix is actually acquiring, and more importantly, what they're not. The TLDR is that Netflix isn't buying the cable networks. The deal structure requires Warner Bros. Discovery to spin off CNN, TNT, TBS, and Discovery Networks into a separate company called Discovery Global before Netflix can close the deal. And this is what we were looking at earlier. The cable networks become their own publicly traded entity available for someone else to acquire. So if the Ellisons' real target is CNN, why didn't they just wait? The original plan was for WBD to spin off Discovery Global in April of 2026. Why force an early auction with an unsolicited bid in October? Why go through aggressive bidding wars you're not going to lose? Unless April 2026 is too late. Too late for what? Well, 2026 happens to be one of the most consequential election years we've had in a while. Texas, Arkansas, and North Carolina primaries hit as early as March 3rd. The rest of the country follows. Every House seat, a third of the Senate, and by the end of spring, the primary narrative is set. The media has already decided which candidates are viable, which get buried, which stories get oxygen. If Discovery Global doesn't spin off until April, whoever buys CNN gets it after the primaries are effectively decided. Too late to shape anything that matters. But if someone could accelerate the timeline to Q1, CNN could change hands before March. And this is the theory. Remember, Warner Brothers wasn't supposed to be sold this year. The plan was for WBD to complete its own spinoff of Discovery Global in April of 2026, separating the cable networks on their own timeline. Then, in October, David Ellison made an unsolicited bid for the entire company, forcing WBD into a formal auction process months ahead of schedule. Paramount kept betting aggressively even as they were being shot down time and time again, which is notably not a very Ellison thing to do. The Ellisons don't throw good money after bad. They don't stand losing fights just for the optics, so why would you force a company into an early auction and then lose? Because maybe losing is the point. Here's what the Netflix deal accomplishes. It forces Discovery Global to spin off, the same separation that was going to happen anyway, but now under regulatory scrutiny with deal pressure and potentially making the spin-off network available sooner. If Paramount's hostile posturing creates enough uncertainty around Netflix's deal, the fastest way to resolve it might be to accelerate the spinoff and let Ellison take the cable networks cleanly. And this is the theory. The original WBD plan was from June 2025 was to spin off oh my goodness. It's too early in the morning. The original Warner Bros. Discovery plan was from June 2025 was to spin off the studios and HBO Max as an independent company called Warner Bros. With Zaslav as CEO. Discovery Global, the cable networks would remain as the continuing entity. The separation was expected to complete in April of 2026. A reverse spinoff where Discovery Global gets spun off instead and the studios remain as the continuing entity, available to be acquired by a third party. That's exactly the structure Netflix's winning bid requires. Zaslav wrote contract language for a deal structure that hasn't been proposed yet. 5 days before Netflix had even submitted a binding bid. Either that's extraordinary foresight, or the structure was already decided. Paramount is now threatening a hostile bid. And remember, this article was written before Paramount's big $100 billion announcement. Paramount is now threatening a hostile bid, which they went through with at $108 billion this morning. Reports say Ellison is livid and legal challenges are being prepared. But what is Paramount actually hostile toward at this point? Netflix is buying the studio, the cable networks are spinning off regardless. Unless the hostile posturing isn't about getting Warner Brothers back, unless it's leveraged to accelerate the Discovery Global timeline from April to Q1 to make sure CNN changes hands before March primaries instead of after. The threat of a hostile bid creates urgency. It creates regulatory complications. It creates pressure to resolve the structure quickly, which means accelerating the spinoff. And if that spinoff happens in Q1, whoever acquires CNN gets it before the 2026 primary season begins in earnest, before the narrative set. Yeah. We already read all this. Monday is December 9th. Monday is December 8th. Oracle announces earnings. Do they? Do they? To be clear, Monday is December 8th. Today, in fact. And they're not even going to be released until December 10th, which is Wednesday. After market close. Whatever. Anyway, I thought it was an interesting theory. You know, I thought it was an interesting theory at the very least. That Larry Ellison, the reason why Larry Ellison is doing this incredibly competitive bid is because they just want the networks, the other networks, before the beginning of next year. Which makes a lot of sense, I think. I haven't dropped any frames this stream. And yet I'm streaming to 2 different places. Incredible stuff. And going back to Netflix, the Trump admin views Netflix and Warner Brothers deal with heavy skepticism, which is kind of obvious, I think. I think it was kind of obvious that this was going to happen this way. The Trump administration views the proposed $72 billion deal for Netflix to acquire Warner Brothers Discovery film and streaming assets with heavy skepticism. Netflix said Friday that it will acquire Warner Brothers film studio and streaming service HBO Max. Of course, Elizabeth Warren has something to say. Anti-monopoly nightmare, of course. A Netflix Warner Brothers, Under Donald Trump, the antitrust review process has become a cesspool of political favoritism and corruption. Well, the New York Post on Thursday reported that Paramount Skydance chief David Ellison met with Trump officials and key lawmakers in Washington, D.C. on Wednesday to press his case against Warner Brothers Discovery potential selection of Netflix as its merger partner. Ellison's billionaire father, Larry Ellison, is close to Donald Trump, obviously. On Thursday, the Wall Street Journal reported that Paramount, in a letter to lawyers for WBD, had warned that a sale to Netflix likely would never close because of regulatory challenges in the United States and overseas. So we have an incredibly lax regulatory system, so long as it's not someone that the president is directly involved with. An absolute shocker. Acquiring Warner's streaming and studio assets will entrench and extend Netflix's global dominance in a manner not allowed by domestic or foreign competition laws, Paramount lawyers wrote. Trump, even before taking office for his first time in the White House, opposed a deal by AT&T to buy Time Warner, saying it's too much concentration of powers in the hands of too few. AT&T bought Time Warner in like 2001, right? Oh, never mind, 2018. I forgot. Oh, was it Time that acquired Warner? Shall we? Warner Media. It was American Online. It was AOL and Time Warner. Oh, I'm an idiot. That's tough. Tragic. Good Lord. So we currently have a big, kind of a big slugfest now between 2 very big companies. One company that definitely cannot afford it, and one company that definitely can afford it. All we know is that Warner Brothers Discovery is winning in the end. Because they're getting acquired and taken off the market yet again. What, brother, Warner must be the most acquired company in history. Time Warner got acquired by AOL. Time Warner got acquired by AT&T. and then they got spun off, and now they're getting acquired again. Warner's just a company that changes hands every couple of years. For whatever the biggest. I'm surprised Time Warner hasn't started hasn't started building AI data centers. That would make Paramount Skydance $100 billion company, because it is really funny to think. It is very funny to think. Paramount is acquiring Warner Brothers Discovery for $108.4 billion, which would make the combined entity a $120 billion company, of which Paramount Skydance is only $15 billion. They're acquiring a company 10 times bigger than their own. And the only reason they're able to do it in an all-cash transaction is because the CEO of Paramount Skydance, his father, is the CEO of Oracle. And confront the money. Insanity. Why is the thing for this Bitcoin? What does Bitcoin have to do with this? Oh, blockchain news. Guys, blockchain news. Paramount Skydance is acquiring Warner Brothers. Amazing. Yo, based Warren Buffett. Warren Buffett says Bitcoin is a gambling token and it doesn't have any intrinsic value. Based. I am super curious. I saw earlier that Todd Combs of Berkshire Hathaway is stepping down. I am somewhat curious. What are some of the big investments he's made over the years? However, that's the big news for Paramount Skydance. Skydance Paramount acquiring Warner Brothers. The saga continues. And so we're gonna see what happens. I tend to agree with the idea that the Paramount Skydance offer isn't a serious offer. And I actually don't even think that it would be a good business combination. I think Netflix probably has more reason to be buying Warner Brothers Discovery than I think Netflix has more reason to buy Warner Brothers Discovery than Paramount Skydance. Right? Paramount has Paramount Plus, and like, so listen, I get it. Scooby-Doo is one of the greatest franchises of all time, and I think that's owned by Warner Brothers. Scooby-Doo may be one of the greatest franchises of all time, and there are two giant companies that are spending hundreds of billions of dollars trying to buy that franchise. Personally, if I had $100 billion, I would also try and buy the Scooby-Doo franchise. uh, Yeah, Scooby-Doo's owned by Warner Brothers. Let's go. Warner Brothers Discovery. I'm glad they haven't sold that IP. As of 2019, the franchise Scooby-Doo had grossed approximately $40 billion in total retail sales over its lifetime. Amazing. I actually want to see. Let's see if I can find this thing real quick. Fully into TE. What is TE? It's T1 energy, isn't it? T1 energy. God, imagine. Imagine buying down here. What a return. I want to see. I'm going to see if I can find this thing because I think it's so funny. I genuinely do. I do think it's so funny. Oh, I don't want to create a space, that's for sure. Please. No. Nice. The post has been deleted by the author. Tragic. Dude owns $400,000 worth of. Yo, show me portfolio value. That's all I care about. RBRK. Red brick? I don't know. TE is deeply undervalued. I'm curious. How undervalued are they? Do they make any money? T1 Energy, Investor Relations. Latest annual report. Let's take a look. 2023. We're off to a great start. Form 10K is on page 25. Net loss per share. My guess is these guys don't make any money. They're restructuring their debt. Amazing. You played the lottery and you lost. They do not have any income. Share performance. I love when companies include share performance. It's my favorite. Because they can just take it out whenever they want. Can I get a revenue, please? They have no revenue. Shocking, really. Absolutely shocking. Executive Vice President, end of revenue. What does he do all day? He stares at empty. He just. As of December 31st, 2023, we have not initiated manufacturing or derived revenue from our principal business activities. Crazy. What do you think the CEO of Revenue does all day? He's like, guys, we need to. He just shows up to every board meeting. He's like, guys, we still don't have any revenue. We need to figure something out. we need to like start selling. We need to start like day trading or something, guys. Let's get a day trading department in here. Anyway, that was a nice tangent. Is there anything more about Warner Brothers Discovery going on? That's basically where Warner Brothers that's basically where the story ends for now. So currently Warner Brothers has a lot of people clamoring to own the business for all sorts of different reasons. Netflix, of course, wants to establish its complete and utter dominance over the streaming space and continue to build out its studios network. Meanwhile, Paramount Skydance mysteriously is wanting to pay $108 billion for a company that is 10 times their size. Perhaps so that they can challenge or begin challenging Netflix, or perhaps just to, as we read in the investigation or investigative article, maybe they just want to accelerate the deal timeline and they want to split Warner Brothers from the Discovery networks and accelerate that so that Larry and David Ellison, to be clear, so that David Ellison can go out and buy those networks before the upcoming election, which would make a lot of sense. If billionaires taking control of media is a pretty common theme nowadays, I think. And CNN is kind of opposition, I think, in many ways. TBS doesn't matter. Who cares? TBS hasn't been relevant in like 15 years. But yeah, hey, I think that is going to conclude this video. It's going to be interesting to see where things go from here. I'm not so confident that Paramount is going to win this deal. I think more than likely, Paramount is just suing is just fighting for the right to buy the other networks and all that. And so, yeah, I don't see much of I don't see much reason to believe that Netflix isn't going to buy Warner Brothers Discovery in the end. Netflix might end up upping their deal, which would be kind of cool, I think. Although, how much? Actually, I'm curious. Netflix is offering like $70 billion. I don't want an XLS. Free cash flow is $2 billion. Actually, they might have the money. Revenues, assets. They have $9 billion in cash. So they're going to take on debt to finance this? Is that what's happening? Yo, that's crazy. They have $9 billion in cash. They have $29 billion in total debt. Vast majority is long term. So so they take out like $80 billion in debt to finance this deal? And I mean, that's the thing. They have the cash flow to buy the company. They have very strong cash flows. They have tons of cash. They got tons of assets. They can put up the money for it. They're good for it. Meanwhile, Netflix can put up the money. They're $1 trillion company, right? No, they're $500 billion. Netflix is only $500 billion. They were pretty close. They were 600 billion at one point. Netflix can very easily put up the money for this. They have a tremendous ability, and that's what I think is. That's what makes me think that this Warner Brothers Discovery offer from Paramount Plus is not a real thing. Because if you look at I don't think it's real. Ah, man. Really? Come on, Google. You're supposed to use AI to know what I want. Yeah. This is okay. Okay, I don't think this is my hot take. I don't think Paramount Skydance's offer is real. And I don't think it makes sense in any real capacity. Paramount is a company that's worth $15 billion. They're trying to buy a company for $108 billion. And the vast majority of all that money is being financed by the father of the CEO of Paramount Skydance. Paramount Skydance, their free cash flow has gone negative in their most recent in the most recent period, right? And they've had very inconsistent free cash flow over the last year. And we can go back even further than this. But they've had very inconsistent cash flows. They're issuing shares to pay down to finance more parts of the company. Their subscribers are not growing nearly as quickly. In fact, they're only growing in the low double digits. Is actually pretty good. Revenue is also growing pretty quickly, but they do not have the revenue. They do not have the cash flow. They certainly don't have the actual cash on hand. They only have a few $100 million in cash on hand. Okay, they only have $3 billion in cash on hand, which is 3 times less than what Netflix has, and they have substantially less cash flows. So this would be purely in the best interest of Netflix. Netflix has the cash flow in order to sustainably own this company. If Paramount Skydance wins this merger, if Paramount Skydance goes out and they win this WBD merger, this company is doomed. I think yo, this is crazy. Okay, so Warner Brothers Discovery does 4.2 total revenues. Warner Brothers Discovery does double. Yeah, okay. Warner Brothers Discovery does double Paramount Skydance's yearly revenue in a single 3-month period. Paramount Skydance's total revenue for the year was $4.2 billion. Warner Brothers Discovery revenue for just the single quarter of this year is $9 billion. So that's $36 billion total for the year. And their cash flows, $700 million, is significantly more. Warner Brothers Discovery doesn't cash flow. What doesn't free cash flow per quarter what Paramount Skydance does in revenue. That's why I don't think this is real. I don't think it's real. I don't think it's real. Global linear networks fell 22%. Bro, what is happening? I can see why they want to get rid of this. 22%? Yikes, dog. The revenue... Oh, okay. They are gaining subscribers, but that's like 1%? That's 0.5%. It's all international, boys. An increase of 2.3 million, which is 2%. Subscriber related increased 1%. Yeah, dude. They have $4 billion. They have more cash than Paramount Skydance does. Crazy. Yo. Total liabilities, man, they are chugging paying down debt. I remember when total liabilities exceeded the total assets of the company. That's very cool. I also remember Pepperidge Farm remembers. I also remember when wow, just blanked there super hard. Crazy. I also remember Olympics content last year, tragic. I also remember when WBD was not profitable. I remember when they were losing a ton of money. When I was an AT&T shareholder, I remember when I was an AT&T shareholder and I was reading through their 10Ks and they were like, guys, our Warner Brothers Discovery thing is not profitable. We're losing so much money. Please help us. Please subscribe to the platform, guys. And they did, and nobody did, unfortunately. And Warner Brothers Discovery, unfortunately, they had to get kicked out. And actually, funnily enough, I don't care about T1 Energy. Funnily enough, AT&T has had quite the performance recently, doubling over the last 2 years, which is a staggering feat for a company that is growing revenues at 2% per year. Genuinely, it is a staggering feat for a company doing revenue, doing basically nothing. Indubitably. But yeah, I don't think, my final thoughts, I don't think Paramount Skydance is serious with this offer. And not only do I not think that the Paramount Skydance is serious with their offer, I think that they're just trying to speed up the spinoff process because Paramount Skydance wants to acquire the mainline networks from Warner Brothers Discovery. And they're just going to let Netflix have everything else because they don't care about the rest of it. Paramount Skydance, I don't think is a serious player in the. Now, I totally get the argument that Paramount Skydance wants to become a serious competitor in the streaming space. I don't think Warner Brothers Discovery is the way to go about doing it. I think that they should build up fundamentally a better base, build out their own company, and then maybe try and make some acquisitions here and there. Now, so it makes sense, right? Paramount went out and bought Skydance, which was a deal I don't think that should have been done. However, it was. Paramount Skydance has had quite a few problems since that deal. Unfortunately, that being decreasing cash flows, inconsistent cash flows, as well as very low growth. However, it's not so bad. But yeah, we will see where it goes from here. I'll if there's a big update, I will make another video on this. We'll certainly talk about it live, that's for sure. Assuming that there's another big update. I still think that Warner Brothers Discovery is probably going to stick with Netflix. Anyway, if you enjoyed the video, subscribe. Come hang. If you enjoyed the video, subscribe. Come hang out live. Link in the description. Crazy. And that's basically what's happening with Netflix. I think that there is quite a lot going on. Quite a lot going on there. Let's see if there's anything new happening. Oh yeah, IBM is buying Confluent. Bro, this is the year of acquisitions and mergers. This is insanity. IBM said on Monday it will buy data infrastructure company Confluent in a deal valued at $11 billion, ramping up its cloud computing offerings to capitalize on AI-driven demand boom. I talked about, this is what makes me so sad. I talked about IBM a couple of years ago and was like, you should buy this stock. IBM is, because I remember, it was 2021, 2022. And I was like, this company is traded between 122 and 144, but they're doing a lot in the cloud infrastructure space. They're up 153% in the last 3 years, which is crazy for a company that has basically been dead for years. Yeah, and people think that this deal is probably going to go through. Confluent fell, and they got. I love when companies do this. You obviously IBM probably doesn't want to buy Confluent here at 20. If Confluent's trading at $27, they're gonna have to offer like 38, 39. But if they fall, then once you get back to here, well, then 28 looks pretty good. But all these shareholders, all the people that bought back here were like, we're just breaking even. This is terrible. All cash, no stock. Crazy. Confluent stock is up 28% today. Here's what we see in our data. IBM's acquiring them. Well, hard to beat that, I think. My kitty has decided to join me. Come, my child, look into the camera. Look at the people. The people. Alright, time to skedaddle. My cat. They're buying Confluent. $31 per share. It's too bad. Honestly, dude, I should take another look at cross country. I really should. Cross country's gotten crushed. I think AMN Healthcare has also gotten absolutely crushed. These companies seem so interesting to me. I think AMN should go out and buy CCRN, to be honest. But these companies always seem so interesting to me. Just a week ago, Cross Country was about to be acquired for $615 million. They're now trading at $262. Which is just utterly fascinating, I think. Yeah, I want to talk about the S&P 500 rebalance and how... Wow, $12 billion in a long-awaited farm aid. Wow. The Trump administration on Monday plans to unveil a long-awaited farm aid package, according to Trump administration officials, offering $12 billion in assistance to a key base of support hit hard by low crop prices and the impact of the president's tariff policies. Wow. $11 billion in one-time payments to crop farmers under the Department of Agriculture's newly designed Farmer Bridge Assistance Program. Guys, we have to save the farmers from what we did to them earlier this year, while the remaining is reserved for crops not covered by the FBA, according to one of the officials who asked not to be identified. The information isn't public. Oh man, it's almost like all of this is a bunch of lies. Anyway. Wait, is this the same comments that we read earlier? Netflix $72 billion Warner Brothers deal led to several price target cuts led by Wall Street analysts as U.S. President Donald Trump warned of market share concerns, underscoring the tough scrutiny that the acquisition is likely to face. The deal that combines the largest streaming service with HBO Max and a major Hollywood studio has also drawn criticism from wow, shocker. Trump warned on Sunday while speaking at the Kennedy Center that the combined group's enlarged market share could be a problem and that he would be involved in this. Why is he getting involved in the decision? Why? Why? White House economic advisor Kevin Hassett told CNBC on Monday that the U.S. Justice Department would examine the deal's impact for quite a while. Netflix has agreed to pay $5 if it could not do, which is, I'm gonna be honest. Netflix has to have a lot of confidence to put up $6 billion if the deal doesn't even go through. Wow. Bunch of people cutting their price targets for Netflix. Tragic. One second. Wow. Amazing. Paramount lawyers sent a strongly worded email complaining about a tilted and unfair process. Me, when I'm a lawyer and I'm sending a strongly worded letter, that's what I get paid to do. Oh yeah, Ted Combs. This looks like the man. This is the face of a man. And that's all I have to say about that. Warren Buffett's Berkshire Hathaway announced a number of structural changes before the legendary CEO steps aside. Among them, the departure of Todd Combs, investment manager and Geico CEO. Combs will be joining J.P. Morgan Chase as head of the bank's new Security and Resiliency Initiative to find direct... Hang on. Combs has resigned to accept an interesting and important job at J.P. Morgan, said Buffett 95 in a press release from Berkshire. J.P. Morgan, as usually is the case, has made a good decision. Strange. Yeah, I'm gonna get rid of this. Thanks. Oh man, you know what I should do? That's what I should do. I want to look at this. I can't type. I can't. This is stupid. This is a week ago? Tuesday. Crazy. We're gonna get back to all of this. We're actually gonna close this. We might look at Solstice later. I kind of want to look at the rebalance. Yeah. Wait, guys. Um, that is very funny. Well, interesting. I might have to take a look at that later. Sues over U.S. military. Who are they suing? Chinese top flash memory chip maker Yangtze Memory Technologies has sued the U.S. Defense Department, challenging a decision to include the technology company on a list of entities allegedly working with Beijing's military. Can I sue the Defense Department? Is that something I'm allowed to do? This is the face of a man. This is the face of a stretched man, and this is the face of a man. It was not 9.3 billion, it was 11 billion. Tesla got downgraded. Tragic. I could totally see why Paramount Skydance would nosedive on the news that they nosedive. Wait, Paramount Skydance. This must be post-merger. Doopida. There's a really good website. If you don't know what it is, it's called Stock Spinoff Investing. I think everyone should go and look at it if you want to know what's going on. Upcoming. It has a list of all of the big upcoming spinoffs that are happening. And I always like looking at it because, you know, especially the completed ones. So Honeywell threw Solstice Advanced Materials away. I kind of want to look at that company. I was looking at it a little earlier. If you don't know anything about spinoffs, they are typically very, very profitable, typically. Yeah, typically spinoffs are pretty solid. GSK was a spinoff, I think. Bayer was a spinoff. Both incredibly well-performing stocks. Well, can't win them all, I guess. Why would they put this on the NASDAQ? Can I filter by performance? Darn, I can't. Resolute Holdings, RHLD. Did we look at this at some point? $200. What are they doing? What is Resolute Holdings doing? Shares advanced $5. They have 7 employees and $120 million in 10 times revenue, by the way. Havas. Seaport Entertainment. Yeah, I remember this. Seg. Seaport Entertainment Group. What a disaster. Revenue is increasing, but net income is bad. Exito. Madison Squash Garden Entertainment. You mean Square? Omniab. OABI. What do these guys do? The Therapeutic Antibody Discovery Company. Okay. Don't care about that. That's what I was... Dude, I feel like this is such a good... Listen, I don't personally like RXO. I've dealt with RXO. I think they're a terrible company. But, like... RXO feels like such a lean company that I feel like they're gonna perform well. Revenue's up almost 40%. Revenue's up over 40% year over year. Not 40%, like 37%. Gross margins. I don't like seeing gross margin as the actual net income. I'd rather see it as a percentage of total sales, because 10% would be like 200 million, because it's growing very quickly. Volume's only up 1%. Okay, this is interesting. Volume's up 1%. Interesting. EBITDA's whatever. So the actual brokerage for trucking is kind of dying, I think. Meanwhile, last mile and managed transportation is growing. Post spent 65% of operating expense reductions over 2 years with a more optimized cost structure. Well, I mean, hey, that's decent. Total cash synergies of $70 million, including $60 million reduction in operating expenses. Okay. Incremental tech. Yeah, okay. Total annualized OPEX reductions. AI image solutions in last mile to ensure delivery and install quality. You can't see this, but GAAP EPS was negative 181 last year. Now it's negative 8 cents. Free cash flow conversion rate of 56%. Ooh, interesting. Capital structure. Net debt's $395 million. Total debts. Notes due in 2027. They got a big revolver, though. Huh. They do. They have a pretty big revolver in terms of liquidity. So they have a lot of liquidity. It's very good. The leverage is 2.3 times. Only 2.3 times for the total company. Capital light structure. Nice chart, by the way, guys. Okay. TL volume. What is TL? Hang on. What does TL mean? Truckload. Shocking. shocking, really. Truckload volume. That makes more sense than ever. Crazy. Truckload volume. Last 12 months leverage is 2.3. Okay. So truckload revenue per load and brokerage gross margin trends. Includes the impact of Coyote. I wonder what Coyote is. Okay, so 12 to 13% gross profit per load per truckload. Okay. Truckload market tightened in September, driven by regulatory changes and capacity exits. Market tightness intensified in October. I guess this makes sense. Okay. Maybe RXO is not the best. Okay, so they bought Coyote Logistics is what they were talking about. Perhaps RXO is just an incredibly cyclical company as well. They're buying back shares, $125 million. What is the total market cap of the company? $2 billion? It's pretty good. Get me out of here, that's for sure. Well, I think RXO is worth looking into. We're tossing on the watch list, that's for sure. I don't think Qnity is worth. I don't really care about Qnity. Figma is now 18 billion, by the way. Figma's worth less than Pinterest. A shocker. Of all shockers. Let's see if I can find this. There's this. Interesting. There was. I believe I read a study a few years back. Talking about setting up investment accounts for children. Okay. I kind of want to. It's gonna paywall me. Nice. Thank you. Wow, a paywall. It's almost like these companies want my money. This is just a transcript. All right. As much as I don't like using the White House's official website, okay. Grab this. Very cool. Oh my. Listen. Okay. Well, yeah, sure. I think I'm gonna have to set my chat as. Unfortunately, I think I'm gonna have to set my chat to. Follower only. Tragically. Ah, man. Fine. Pause on this site. We got this. I'm somewhat curious about the other side of this. The GAO, I trust these guys. That's for sure. If the GAO is saying it, it's probably true. Please disable ad blockers. We won't show you ads. Immediately shows me an ad. Thank you. Okay. $7 REIT with a 16.5% dividend. Is this MPW? Darn, it's not. Let me see if I can find this out. Oh, dude, remember Ari? I remember this. $10 for 10%? Crazy. You just have to be comfortable losing literally all of your money over the next couple of years, unfortunately. MPW does not have a 14.5% yield. How's Jeff Bezos? GNL. Let's find out. Only 10%. Global Net Lease. This company is dying. 12%. Tragic. Yo, remember Armor? Oh, I feel like I'm going through a time capsule. Armor Residential. Yikes. That's tough. I remember getting pitched Armor at like $40 a share. Ugh. That's just tough. Down 95%. Unfortunate. Yo, AG&C? I hate REITs nowadays. I don't think there are any good REITs. Unless you find maybe like a good there might be a good I think there's a case for Unit Group Delaware. Fascinating. I think that there is a case to be made for some of the long-term storage companies. Wait, what? What does this company do? Unity Group stock. Wait, is this Ubiquity? No. This is something completely different. Wait, this company rents fiber? Is that what this thing does? Is that what this company does? Why is this company dying then? Are they just making less and less money every year? Kinetic market states. They added 24,000 subscribers, which I think is 2%. Never mind, it's 20%. With revenue growth of 26%. ARPU's up 10%, dude. Okay. We're actually gonna look at this later. I'm so curious. For now, we're gonna talk about. We're going to talk about funding the children. We'll start with the White House stuff, and then we'll go to the other stuff, and then we'll... Amazon coin. I buy all my crypto on Amazon.com. Amazon.com. Wow. Still getting views, huh? Yeah. No, thank you. Yeah. So, the big news. Tech billionaires Michael and Susan Dell announced Tuesday that they are pledging $6.25 billion to create 25 million additional Trump accounts for children across the country. These accounts will be seeded with $250 each and are available for children who missed the eligibility cutoff for the $1,000 federally funded Trump accounts for babies born after January 1st of 2025. Children living in zip codes with median incomes below $150,000 will be the first to receive the funds, the White House said. The greatest investment that we can possibly make is in children, Susan Dell said alongside President Donald Trump at the White House. Amazing. No, get out of here. This is going to come in handy later. Trump accounts 1,000. Can I just get the... Oh, the IRS is issuing guidance. These are 100% going to be taxed. Oh, tax deferment vehicle. Okay. Oh, this is the one that converts into like a... It converts into an IRA once you turn 18. Okay, I don't think I care about that. That seems more... Okay, I think we're actually going to start here, then we're going to go to Michael Dow. Okay, so if you don't know, catch you up to speed. The President of the United States has decided that a new initiative that he wants to do is to basically give every child born after January 1st of 2025, so this year, he's going to give every single child essentially a bank account, an investment account invested in the S&P 500 that's going to have $1,000 in it. Millions of babies born in the United States in the coming years will be eligible to receive $1,000 Trump account, courtesy of the federal government. The pilot program is a creation of President Trump's signature legislation that brings a host of changes to tax and spending programs. Money in a Trump account will be socked away until the beneficiary child turns at least 18. The idea is that $1,000 in seed money will grow over time, invested in low-cost stock funds that track market indexes. Trump accounts will give children the chance to experience the miracle of compounded growth and set them on a course for prosperity from an earlier age. The new accounts have sparked a number of questions, including how they'll operate, how they'll compare with other saving strategies, and what impact the accounts will have on America's gapping wealth divide, if any. For financial experts, one benefit of Trump account is easy to spot. I'm going to take the $1,000, definitely, nothing wrong with that, says Michael Reynolds, a certified financial planner at Elevation Financial in the Indianapolis area. Who is eligible? The program offers the $1,000 investment to children born after December 31st, 2024, and before January 1st, 2029. To take part, they must be a U.S. citizen with a Social Security number. Each child account will be seeded with a one-time government contribution of $1,000, funding an investment that tracks a U.S. stock market index, according to the White House. The year the child turns 18, the funds become available to them. Parents can also open a Trump account for a child not born in the 4-year window, but the account will not be eligible to receive a $1,000 benefit. Parents, relatives, and others can contribute up to $5,000 annually until the year the child turns 18. Employers can chip in. Those special rules apply to them. A company can deposit up to $2,500 into an account for an employee's eligible dependent child without adding to the worker's taxable income. Very cool. Very cool. I think companies that do this, very based and epic. The money must be invested in an eligible investment such as a mutual fund or exchange-traded fund that tracks an index like the S&P 500, this legislation states. The fund cannot have annual fees and expenses of more than 0.1%. This is called the prop-up economy. Actually, I think this would make for a great video. The index it tracks must comprise equity investments in primarily United States companies. I just had an insane idea for a dollars and cents episode. For dollars and cents, it's called the prop-up economy. Yo, I'm cooking. I don't know what I'm cooking, but this is such an interesting idea. Let me put this down for later. Hang on. I'm sorry to derail. I'm only derailing for yo. Don't know what all that is. Bunch of junk, I think. So basically the theory is we're living in sort of a propped up economy and where the government basically has to step in and they have to do literally everything for everybody. They have to prop up the housing market with 50-year mortgages, obviously, because nobody can afford to buy houses, and so you have to lower the monthly payments so people can actually buy them. You have to prop up the stock market because everything is crashing. So if the government is basically fronting thousands and thousands of billions of dollars into the stock market, then you're propping up the stock market. The government is obviously propping up all of the farmers, which they absolutely completely destroyed which the president of the United States completely destroyed with tariffs at the beginning of the year. And they're propping up, and they're basically forced to prop up every industry. The United States government is forced to prop up basically every industry in the United States through subsidies, because everything is nothing is good anymore. Anyway, live crash out, by the way. It's not great. Anyway, so continuing on, to come up with an estimate, he uses a rate of 8%. The government puts in $1,000 and no other money is contributed. Fast forward 18 years, 8% return. Should give you about $4,000. Pretty good, honestly. $4,000 free dollars at the age of 18. Why not? If you maxed out contributions, you'd have about $200,000, which based, I think. I think we need a little bit more baby bonds. That's what I was looking for. Baby bonds have been a bipartisan idea to help children who are disadvantaged by the racial wealth gap, and just like the wealth gap in general. But critics say Trump accounts don't go far enough to prioritize helping families with fewer resources. Yo, what is this? I don't know if I want to read this. Okay, we got a little off topic there. Anyway, so basically, $1,000 to every child born for from the beginning of this year to the end of Donald Trump's presidency. Basically, it seems to be a tax-advantaged account. Let's take a look at what the IRS actually says it is. The Department of Treasury and the Internal Revenue Service today issued a notice announcing upcoming regulations and providing guidance regarding Trump accounts, which are a new type of individual retirement account, an IRA. So it is an IRA structure for eligible children. This provides a general overview of how Trump accounts works and addresses certain. All right, let's take a look. Let's go reading. Let's read. We read here. The notice informs taxpayers that the Department of Treasury and the Internal Revenue Service intend to propose regulations providing guidance with respect to 70204 of Public Law, commonly known as the OBBBA, which applies to taxable years beginning after December 31st, 2025. Okay. Section 4. Okay. General overview. A Trump account is a type of traditional individual retirement account that is established for the exclusive benefit of an eligible individual and that is designated at its establishment as a Trump account. When the Trump account is opened, the eligible individual is the owner of the Trump account and is referred to as the account beneficiary. Amazing. A Trump account is subject to special rules inapplicable to other individual retirement arrangements under Section 408, most of which apply only during the period that ends before January 1st of the calendar year in which the account beneficiary attains age 18. For example, a child born on October 2025 would turn 18 in 2043, and therefore the last day of the growth period with respect to the child would be 2042, the day before. The special rules that apply only during the growth period include funds in a Trump account that can only be invested in eligible investments. Okay, so this is going to be heavily restricted, probably to broad market indexes. A Trump account has a separate contribution limit from other retirement arrangements, which we read earlier. A Trump account is generally not allowed to make distributions. Okay, also makes sense. No deduction by an individual is allowed under Section 219 for any contribution to a Trump account, and trustees of Trump accounts have similar but different reporting requirements from trustees of other IRAs. After the growth period, most of these special rules cease to apply, and the rules under Section 408 governing traditional IRAs generally apply, as described with coordination with IRA rules discussion. Okay. Upon an election under the pilot program, $1,000 is paid to the secretary to the Trump account of an eligible child. An eligible child is a qualifying child, yada, 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 yada. Okay, a pilot program contribution from the secretary of $1,000 for the eligible child. Qualified general contributions funded by states, Indian tribal governments for member. Okay, contributions. Okay, I don't think we're going to read all of this. Let's actually look at distributions. During the growth period, no distributions may be made from a Trump account except for qualified rollover contributions. Qualified able rollover contributions, distributions of excess contributions, and distributions upon death of the account beneficiary. Okay. Are generally subject to the rules that apply from distributions of traditional IRAs. Okay, so it's basically an IRA. A distribution may be subject to the 10% additional tax on early distributions if an exception does not apply with respect to the account beneficiary. Okay, so basically an IRA, except it extends all the way to children and is exclusively for the benefit of children. So employers can obviously contribute up to $2,500, which we read earlier. $45.47. Ugh. What a... I dislike this. I have a problem with the President of the United States of America, currently. That problem fundamentally is, I do not think it is a good thing that he is attempting. You know what? As much as people may not like him, as much as I may not like him all that much, Obama made a really good point a couple of months ago, and that was, the people in power today are so desperate to cling to power and to try and leave some semblance of a legacy that they're doing just literally anything. It's embarrassing, to be honest. So the dude that's running this country is so desperate to make sure that every single person knows that he is the president of the United States and that it's all his doing and that he's the only one and that it's literally a cult of personality. And yes, I'm crashing out over this because Donald Trump is creating an account. So baby bonds are a great idea. They've been a great idea for literally years. And we're going to get into this in a second. Baby bonds are a great idea. Donald Trump is so self-absorbed, he has to make sure every single person knows that this was his idea, that his name is going to be on the account, and that the actual IRS form is 4547. Which is, of course, if you don't know, Donald Trump's entire identity is wrapped up in the fact that he's president of the United States, and that he was the 45th and 47th president of the United States. Literally, you have to pervade every single part of everything that you're doing with your absolutely self-absorbed, idiotic ideology. I hate this. I hope one day we are able to rend ourselves of this horrific blight. Anyway, crash out over. Let's go back to reading. 4547, once it is released at any time, including the same time that the 2025 income tax return is filed or through the online tool or application. The online tool or application for making the elections is expected to be available on trumpaccounts.gov. Do we click the link? Yes, we do. Wow, literally nothing. December 17th. It's 9 days away. Okay. I don't think that there's too much there. There's too much more there. So basically we have the Trump accounts. This was established a couple of months ago, that we have these sort of Trump accounts that the federal government is going to contribute $1,000 to every child born over the next 4 years or so, which is objectively, I think, a pretty good idea. If you don't know much about the actual, there's actually studies to back this. These things, this idea has been around for a very long time. They've been called baby bonds for a very long time, and it seems like it's a pretty good way of actually supporting the next generation. So, for instance, we have a study from a couple of years ago, 2013 to be precise, so 12 years ago. Savings account for children linked to later financial success. A new series of reports based on research conducted at the University of Kansas shows that young people who have savings from an early age are more likely to maintain positive relationships with financial institutions, diversify their financial portfolios, and accumulate more assets as they age. Terry Friedline, assistant professor of social welfare at Kansas University, has authored Children as Potential Future Investors. a 3-part series published by the Assets and Education Initiative at KU's School of Social Welfare. She analyzed data from the panel study of income dynamics, a largely nationally representative survey that has tracked American families since 1968. Interesting. Oh, wait. Is this the actual data thing? Ah, it's down. One sec. Friedline analyzed data from 2002 to 2009 with young people who averaged age 17 years old in the beginning of the study and 23 at the end. The data showed that those who had savings accounts to begin with maintained them, diversified their portfolios by investing in different financial products, and accumulated more savings overall than their peers who did not start with accounts. We found that they are twice as likely to continue having savings accounts and 4 times more likely to have invested in stocks. We also find that if young people had a savings account as a child, they accumulated an average of about $2,000. Those who did not have savings accounts earlier in life only accumulated about $100, which is 20 times, which is crazy. The studies controlled for things like whether subjects attended college, were employed, if they grew up in lower income households, if they were raised in a single or 2-parent family house, if their parents attended college, or a number of other factors. Holding for all of those things, we found the positive relationship between early savings accounts and financial outcomes held true. In the long run, it shows young people were more likely to invest. We can begin to see the financial benefits of savings account opened just a few years earlier. Imagine what these effects could look like if accounts were opened in kindergarten. The findings illustrate that not only are savings accounts opened at an early age beneficial for the investor, they may also be beneficial for banks and financial institutions. Initially, young people might not have much money to save or invest, which can be a disincentive for banks to take them on as customers. At the same time, account fees and startup costs can prevent some young people from opening savings accounts, but data shows that as they age, young people save more, invest in multiple financial products, and maintain their relationships with banks, making them ideal future customers. We see down the road that young people are saving more and using their financial products. Even if banks have to think long term, it might be beneficial to generate early relationships with customers who are potential future investors. Saving from an early age not only provides assets, but it may give young people a real, tangible education in finance. It's not an abstract idea or classroom lecture about what an interest rate looks like. Young people might also get to learn about savings accounts and finances from experience. Friedline is quick to point out that savings accounts are not a silver bullet that will automatically solve all financial problems. However, the research shows the positives that come with establishing savings accounts early and helps to justify making early childhood savings accounts widely available as a means for educating young people about finances. And she's going to do more research in the future. And so we have this sort of foundation of like, hey, it's a good idea to set children up with financial products. Well, it's a good idea to set children up with these accounts at a very early age because not only are they more likely to have money as they age, they're more likely to be engaged with those financial products in the future. The Government Accountability Office, which if you don't know what they are unimaginably based, also did a couple of studies that were somewhat skeptical of this idea. Children's savings accounts programs can help families build savings and envision college. What the Government Accountability Office, 82 children's savings accounts programs operated and had collected enrolled 82 CSA programs operated and had collectively enrolled about 700,000 children in 2019, according to survey data from the nonprofit organization Prosperity Now. These programs, operated by states, cities, and other organizations, use a variety of strategies to enroll families, especially those with lower incomes, and help them save and prepare for college. For example, CSA programs enroll families by parenting the children. Crazy. CSA programs enroll families by partnering with trusted organizations or through automatic enrollment, according to the consumer CFPB. Oh, the CFPB, the thing that got dismantled by the President of the United States and his cronies? Amazing. In addition, these programs help fund families build savings accounts once children are enrolled by, for example, providing initial deposits or financial education. Exactly what we just talked about in that other study. While experts GAO interviewed said savings have modest may be modest given lower income families and programs' limited resources, CSA programs also aim to help lower income families prepare for college, such as by increasing financial knowledge. There's evidence that CSA program strategies have positive short-term effects on families, including those with lower incomes. These effects include increased CSA program enrollment and participation, amounts saved, and educational expectations based on GAO research. For example, strategies such as automatically enrolling families and providing financial contributions may help CSA programs reach more families and encourage saving. Several studies of a CSA program that used both these strategies found increases in the number of children enrolled and the amount saved by enrolled families. One study found that families who were enrolled for 7 years saved 4 times more than their own money. On average, those families who were not enrolled, $261 compared to $59, which isn't much. But hey, it's not nothing. When including financial contributions from the CSA program, enrolled families had about 6 times more savings, about $2,000 as opposed to $323. Enrollment and participation in CSA programs may also increase families' educational expectations for their children. For example, a study found that parents with children enrolled in one CSA program were nearly twice as likely to expect their children to attend college. However, information on college enrollment and other long-term effects on families participating in CSA program is limited because most of the children have not reached college age yet. Yeah. So basically, the GAO found the exact same thing. If you have programs that set children up with savings accounts very early in life, you get good results. They save more, they're more likely to engage not only in education, but the family in general is more likely to engage in financial education. So with all that said, that brings us to about a week ago. A tech billionaire, by the name of Michael and his wife, Susan Dell, announced Tuesday that they are pledging $6.25 billion to create 25 million additional Trump accounts for children across the country. These accounts will be seeded with $250 each and available for children who miss the eligibility cutoff for $1,000 federally funded Trump accounts for babies born after January 1st, 2025. Asked how this donation came to be, Michael Dell started, we started talking about Texas only at the beginning, and then we thought about it some more and went back and forth, as we do on these things, and this is where we ended up. The Dell said they considered making the pledge for a long time, but they didn't want to take the pledge to be the end of their involvement. Michael Dell encourages states to really grow financial literacy to help educate families about how the accounts and markets work. These deposits will reach the accounts of most children under 10 and under who were born prior to the qualifying date for the federal newborn contribution, the Dell said in a statement issued by their foundation. Children older than 10 may benefit too if funds remain available after initial signups. The Dell family said it is an incredibly practical and direct step to help families begin saving today. The Dell family gift is expected to reach nearly 80% of children aged 10 and under across 75% of U.S. zip codes, according to the nonprofit Invest America. Children born after January 1st and until December 20... Oh, yeah, we already read all this. The accounts will open and begin accepting contributions starting on July 4th of 2026, next year. The accounts will initially be held by a financial firm designated by the Treasury Department, but later will be able to be transferred to any brokerage firm. Very cool, very cool. Trump accounts can be invested only in low-cost index funds or ETFs that mirror the S&P 500 or another American stock index, according to White House Council of Economic Advisors. So tangentially, we're going to talk about two other things. We're going to talk about two other things that are happening here. Why is Michael Dell doing this? Well, it's pretty simple. It's pretty simple why he's doing this. He wants to buy TikTok. It's pretty simple. Larry Ellison, Michael Dell, and the Murdochs will be involved in TikTok deal. President Donald Trump said on Sunday, tech and media giants Larry Ellison, Michael Dell, and Lachlan and Rupert Murdoch will be part of the group to take over TikTok's algorithm in the acquisition of the social media platform's U.S. operations. You know, they are very well-known people, and Larry Ellison is one of them. He's involved. He's a great guy. Michael Dell is involved. I hate to tell you this, but a man named Lachlan is involved. Tragic. Trump added that Rupert Murdoch is probably going to be in the group. So, Trump's comments are a change from the consortium of developers previously named in the TikTok deal. The Trump administration had said that the group of investors would include Ellison's company Oracle, along with Silver Lake and Andreessen Horowitz. White House press secretary, whatever. The makeup of American investors is required by the bill passed by Congress in April of 2024, which required a nationwide ban of TikTok operation. Yikes, dude. The makeup of American investors is required by a bill passed by Congress in April of 2024, which required a nationwide ban of TikTok operations in the United States unless the social media app sold about 80% of its assets to American investors. This doesn't mean anything because the President of the United States just decided that it doesn't mean anything. To be very clear, ever since this bill was passed, there was a 90-day moratorium on TikTok getting banned in the United States, and Donald Trump just decided to write an executive order that said that TikTok isn't getting banned. And he just keeps writing these 90-day executive orders saying, oh yeah, TikTok gets another 90 days, despite the fact that we have a bill from Congress saying TikTok needs to be banned in the United States unless they sell immediately. That being said, one of the reasons why he's delaying it so much is because Donald Trump is trying to figure out a group of investors to sell TikTok out to. And I'm sure this is obviously a very complex deal. TikTok doesn't want to sell anything. TikTok just wants to continue remaining operational in the United States. But the United States, it's obviously a security problem to the United States. And so it behooves the president to figure out a way to continue to extend TikTok in the United States, and to get it sold as fast as possible. And so Michael Dell is obviously in the running to be part of this group of investors to buy TikTok. And so it makes a lot of sense that the Michael Dell would attempt to bribe the president of the United States, who has been known to take bribes in the past. I could provide many examples of this. Anyway, so that's really why. That's a real reason why. That's the real uncut reason why Donald Trump is attempting to. Yeah. So, it's a good idea. So fundamentally, baby bonds are a great idea. And, yeah, baby bonds are a great idea. The only problem is, it's infested with this horrific man's, agenda, or it's disgusting. This fingerprint is disgusting. Anyway, welcome to the prop up economy. What was the other thing that we were gonna go? It's here, right? Oh yeah. In response to this gift, Dell shares are up on nearly 20%. Remember when? Crazy. They're up 1,000% in the last 10 years. Crazy stuff. But yeah, that's kind of. That's what's going on. Bad people can make good decisions every once in a while. Yeah, it's a good idea fundamentally. I think baby bonds are a widely popular idea that have not had much actual support. I think because of the lack of financial literacy here in the United States, but fundamentally, there's a lot of different things going on here. Obviously, you have the president of the United States who wishes to prop up the American stock, the American stock market by essentially pumping, at this point, tens of billions of dollars into. Oh yeah, the honestly, the biggest beneficiary of this is BlackRock and Vanguard. What is it? VOO. Um, Actually, I'm somewhat curious. Oh well, can't do anything about that. Oh well. Yeah. So there was yeah. The real beneficiaries of this are companies like Vanguard and BlackRock, who have very low cost index funds that track the S&P 500. So obviously, as we've been talking about this, the big thing that all of this money is going to get invested to is the S&P 500. And the companies that run the largest index funds that track the S&P 500 are Vanguard, BlackRock, State Street, these kinds of companies. And so you're going to get tens of billions of dollars invested directly by the United States government into all of these funds. And it's literally by law, you're kind of propping up the S&P 500, which is broadly the American stock market, which accounts for like a 90% of the entire market capitalization of the stock market. So yeah, like I was saying, the real beneficiaries are the S&P 500, the big brokers that do the S&P 500. Again, we also talked about, because what's specified in the actual Trump accounts thing, in the Trump accounts setup, in the language of the setup, in the language used for this, they want S&P 500 index funds or American stock tracking things that are really low expense ratios. And so those just so happen to be dominated by Vanguard, State Street, and BlackRock. And not Blackstone. Blackstone is private equity. And so these guys are going to be the ones that are really going to win in the end of the day, because they're going to be the ones to win at the end of the day. Because they're basically getting tens of billions of dollars of money artificially pumped not only into their businesses, and they're going to be able to collect expense ratios based off of U.S. government dollars, but fundamentally the S&P 500 is going to get propped up by this artificial investment. And we say artificial, obviously, what is artificial really? But that's essentially what's going on with this whole thing. It's fundamentally a good idea. I think the execution is very poor. I think there should be a more bipartisan. There should be a better built out way. There's a better built out way of doing this. Instead of like the executive just coming in and saying, "Hey, I'm going to do this. We're going to put $1,000 in every person's account," and everybody else is going to have to figure it out. Post that. I think it would be better if we had a more unified plan of like, here's, these investment accounts. Here's generally, here are specific tax advantages, and I think this could have been planned out a lot better instead of just like the president coming out and saying, "Hey, we're going to do this now," and then forcing all of the organizations around him to basically catch up to his harebrained schemes. So I think overall it's a good thing. The execution is very poor. However, I very much so look forward to getting more free money from the government. Thank you, President of the United States of America. Anyway, if you enjoyed this video, be sure to subscribe and like, and come hang out live. We talked about this live. We talked about all this live. Come hang out. Link in the description. Tragic. I'm going to do... a hedge fund profile, which I think will be interesting. Let's see if there's anything new going on. Carvana's up 12.5%. Stupid. This is very strange. Why is Yahoo Finance, why is one of the main people for Yahoo Finance using a lapel mic? Where, especially considering she's basically conference calling with other people. Why is there no boom mic here? Where's my Sennheiser MKH416? Why are we not using a boom arm with a mic? Crazy stuff. Maybe Yahoo Finance really is falling apart. Who's this guy? Who's this? It's Howard Green, Mitchell Green. Mitchell Green. Scuderia Corsa Racing? Crazy. And then, what's a... I think I want a little more time. I want a little more time to do sort of a deep dive on some value stuff. Yo, who could have guessed that the United States government would get managed so poorly that the stock market would fall at the same time that bonds are? Who would have guessed? This has never happened before. Makes dollars and cents look like a real nut job. Talking about the pivot is coming 3 years ago, and then all of a sudden the pivot never comes. It never does. Tragic. You know what? I know Boston, Omaha like the back of my hand. There are no presentations. Wow. We're going to run through Boston, Omaha real quick. These videos have been performing very well. Actually, I might do price change. I've just been sort of over the last month, right? And it has only been about 5 weeks since I started doing all this. I've noticed that the content that performs the best is the content that talks about like value stocks and stuff. And so I think I might start doing more of that content in the future. Wow. Is it from this? No, it's not. Oh, wait. It might be. Yeah, it is. Okay. Yeah. So we're going to talk about Boston Omaha. Boston Omaha is a company that I think has gotten beaten up over the last couple of years for unfair reasons. Over the last 3 years, we've seen the company fall about 50% in terms of their share price. Despite this, the company continues to grow quite quickly. And one thing that you have to know before we get into all of the discussion about Boston Omaha is that this company is broadly divided into 3 parts. One of the things that you need to know about this company before we get into all the discussions of it is that it's divided into a lot of different parts. A very large portion is Link Media Outdoor. This is outdoor advertising. This is literally billboards. The company goes out and buys billboards, and then they service those billboards, and then they collect very high margin revenue from those billboards. As of their most recent earnings report, they pulled in about $11.8 million from these billboards, and the gross margin is about 70%. So they make a lot of money off of these billboards. There's a lot of net income that's coming off of these billboards. Now, obviously, this particular business segment isn't growing tremendously quickly, especially right now because we've seen kind of a crunch in advertising dollars. But historically, Link Media Outdoor has been one of the fastest growing sectors of the company in sort of lower rate environments when you're seeing more economic activity. But as of right now, Link Media is kind of struggling a little bit. The big growth engine for the company recently has been Boston Omaha Broadband. The company has made several acquisitions over the last couple of years, including Airbeam and InfoWest. And basically, they are just going out and they're buying all of these broadband providers. And so revenue is growing very quickly. This is also incredibly high margin revenue. So Q3, the growth in the most recent earnings report is, again, only 2.3%. But again, there's been a bit of a struggle sort of across the board, but the gross margin is 80% on this entire business segment, and so they're pulling in a lot of money from this business segment. Year to date has been, if you look at the sort of they sometimes they like to break it up into more individual stuff, and so the more individual divisions are growing incredibly quickly, but as a whole, growth is slow but steady. Recently, the really big growth engine for the company has been General Indemnity Group. This is literally surety insurance. Surety insurance basically is a bond that is provided by an insurance company that one particular party will comply with contractual obligations, and so the business that goes out and purchases a surety insurance bond is obligated to perform a specific task, basically, in order to, and it's basically insurance that something that a party has said that they're going to do, they're actually going to do, and they're going out and they're buying insurance that this is actually going to happen. They've written a lot of premiums. Again, another fairly high margin business with almost 50% gross margins across the board. And then their loss ratio has gone up a little bit, but it has stayed mostly, well within reasonable bounds. And so these 3 sort of major business segments: insurance, broadband, and Sorry about that. So these three major business segments, the insurance, the broadband, and the very incredibly high margin. Lost my train of thought now. So these three business segments, the broadband, the insurance, and the... What's the last one? Okay. The billboards, the insurance, and the... I can't say all three of these together. Billboards, insurance, billboards, broadband, insurance. The three major business segments, the billboards, the broadband, and the insurance, are all incredibly high margin businesses. And so all of that money that comes in from those high margin businesses is fueling what I would say is the main growth engine for the future, which is their investments. And so fundamentally, Boston Omaha is an investing vehicle. And so a couple of years ago, in fact, I even made a video about this a couple of years ago on Dollars and Cents, where I talked about the main thing about this company is basically that they're Berkshire Hathaway too, right? And so they're going out and they're making good investments, and those investments are what is fundamentally powering a lot of the growth of the company in the future. So they've gone out and bought everything from banks to, they have, build for rent, which is they've build for rent, which is their yikes. Build for rent, which is their, what is the name? Realty. REITs? Real estate. God, I can't think of these names. They've Build for Rent, which is their real estate division. They have an entire fund. The gross, the actual value of the fund is $4 million, but the proceeds, they've brought in $11 million in proceeds from Build for Rent just in the last year and a half. They've gone out, they've bought banks, they've bought more insurance companies. Their big investment is, they have two really big investments, Sky Harbor and Dreamfinders Homes. They have two really big investments, Sky Harbor and Dreamfinders Homes. They're also buying back shares, which is incredibly good to see. There's been a lot of concern with this company that things might actually be slowing down, and so they have decided that they're going to use some of their cash to start buying back shares of the company, which is good to see. So and sort of fundamentally, more broadly, one of the really big things that they have been able to do is that they combine a lot of their businesses together, where every single individual part sort of feeds into everything else, which is working tremendously well. So their broadband division is partnering with another company that they're invested in called Dreamfinders Homes. Dreamfinders Homes goes out and they build not rental communities. They go out and they build communities for homes, which they do tremendously well. They're very capital light. They have had tremendous success, not only in the places that they've been investing in, but also they're not building spec homes. They're building homes that have actually already been purchased in communities that are growing very quickly. And so fundamentally, they're doing very well. Dreamfinders Homes has partnered with the broadband division of Boston Omaha, and they've created fiber fast homes so that every new home that Dreamfinders Homes builds, they automatically come with a fiber connection from Fiber Fast, which is Boston Omaha. And so Boston Omaha is winning on both ends here. First of all, they have the growing broadband business segment, which is feeding into a partnership with another company that they actually own a piece of, which is Dreamfinders Homes. And so it's this incredible sort of meshing together of all of their sort of nascent businesses that they own, which is why I think Boston Omaha is such a compelling investment moving forward. Whew, yikes. But yeah, Boston Omaha has been a company that I've been investing in over the last couple of years, and I think that they continue to do fairly well. There was a bit of drama. There was a bit of drama. So one of the really big reasons this company was so hyped up, I do think I I started buying around the hype bit, but I sort of bought for different reasons. One of the reasons why I thought this was such a good company initially was that one of the reasons why I thought this was such a good company is because there are co-CEOs to this company, and typically companies that are run by two CEOs are typically tend to perform a bit better than companies that are run by one CEO, so long as there's a unified vision for what the company should look for. And at the time, there was. The two CEOs that were running this were Alex Rozek and Adam Peterson. Co-CEO Alex Rozek had a lot of clout because he was the nephew of Warren Buffett. He was the nephew of Warren Buffett. Yeah, and so he got a lot of clout initially because people were like, "Oh, Warren Buffett's like the greatest investor ever, and his great nephew is now running a company, and it's doing sort of basically the exact same thing that Berkshire Hathaway is doing, which is investing fundamentally in their businesses." And so there was a lot of clout that surrounded the company, and I think that the stock price was hyped up quite a bit because of Alex Rozek, the appearance that Alex Rozek would be sort of the incredible investor heir that of sort of like a sort of Warren Buffett style guy. Fundamentally, Alex Rozek did leave the company, and as a result, the company has slid quite a lot in terms of stock price. This has also combined with the fact that the advertising revenues are not growing as quickly as they were, partially because of the decline in just the general economy. But I think overall, the company has suffered a lot of weakness recently, weakness that I do not think is entirely reasonable. The company is cash flow positive, which at the time that I started investing, they were not. They have been able to reduce their expenses, and their revenue has grown to the point where they are profitable consistently. Now, obviously, if you go and you read their most recent earnings report, you will see that they are unprofitable, and that is because, hang on. By the way, their total assets, this is very interesting. Hmm. Depreciation. Total other assets is crazy. So as you can sort of see, Their current assets, they have about $37 million in cash and sort of a bunch of other, U.S. Treasuries and sort of short-term investments in marketable securities for a total of $126 million. Currently, the firm is trading at $423 million. And so in total, their total assets are $721 million. This is mostly made up with the vast majority of their assets are tied up in their investments. So this is like their Dreamfinders home stake. This is their Sky Harbor stake. This is, all sorts of everything. Goodwill is $182 million. But if you take a look at their actual liabilities, their current liabilities is only $61 million. Accounts payable is about $21 million. And so funds held as collateral is $13 million. So this isn't even really a liability. This is, money that you have to hold as collateral for your insurance business. And then unearned premiums is $14 million. And so there isn't like a ton of actual debt here. The total amount of debt is $173 million. The total amount of liabilities is $173 million. Lease liabilities is $55 million. And then long-term debt is about $43 million. And so they can very easily service this debt. Their cash pile is their cash pile of $37 million is easily enough to service this $40 million and $43 million in debt. They are also beginning to be consistently profitable. If you sort of look at the net income statement of this company, you sort of get a different statement, but that is because a lot of their investments are in publicly traded companies. So, for instance, Dreamfinders Homes is a publicly traded company, and they fluctuate quite a bit. They're a very volatile company. They're a sub $2 billion market cap company, as well as Sky Harbor Group. This is also a publicly traded company. This fluctuates dramatically. This also used to be a SPAC. A sub $1 billion. This is an actual microcap company. But their stakes in these companies, because they are publicly traded, they get rated literally every day, and so the actual net income of the company swings wildly based off of the proposed value of their investments. It's something you wouldn't typically see in companies like Berkshire Hathaway, for instance. You don't know how much Geico is worth, and so they don't actually have to, put out the fair value of Geico isn't changing, 40% in a year, and that's not going to typically affect the actual the impact on the balance sheet of Berkshire Hathaway's balance sheet. It's not going to affect Berkshire Hathaway's balance sheet all that much, as opposed to if Berkshire Hathaway's balance sheet swings wildly if Apple goes up, 30% a year. So again, you could sort of there are similarities in these two companies. But yeah, I think overall there's a lot to like here. There's a lot to like, and so you're fundamentally buying a. Hang on, yeah. There's a really good line in the most recent annual letter. They write these annual letters, which are actually really good. Yeah, so year over year, like this is really solid. Link Media approximately 4%. Yeah. Free cash flow double digits. And Boston Omaha grew by about 50%. A lot of that is acquisition based, of course. And then General Indemnity Group grew, high double digits, 40%. 54% on the EBITDA. Their Boston Omaha asset management is growing tremendously. They continue to buy this Sky Harbor common stock. And they continue to make just really good investments overall. And combine their business with other businesses to generate incredibly high, not only gross margin, but also incredibly high just returns in general, whether it be stock price appreciation or otherwise. But yeah, I think there's a lot to like in Boston Omaha. If you ever get bored, you can read through their shareholder letters, which are very interesting to read through. Just to you get a very good grip of their sort of their approach to investing, just in general. I think it's really good. So, yeah. Overall, I think Boston Omaha is quite worth looking into if you're interested in sort of one of the big things about investing in Boston Omaha is that they are a microcap company. They're worth less than 500 million. They're a microcap company. They're worth less than $500 million. Granted, they have an excess of $550 million on their balance sheet. So if you were to buy the whole business and sell it off, you'd make 25%. But this company is incredibly volatile, and you are basically betting on one guy's investing decisions, which is Peterson, the guy that runs the company. And so fundamentally, you're betting that Boston Omaha, not only with Peterson but his entire staff, that they will continue to make good investing decisions, and that those investing decisions will continue to grow over the long term. And that's basically what you're betting on. And so you're taking a very large bet. There's a lot of risk with this company. I think there's a lot of reward, so long as they can continue to execute in the way that they have, because they have a very long track record. They have they've been around since 2011. Since 2011, they've had a very good track record of investing not only in basically every business segment that they have, from advertising to billboard to broadband to the insurance businesses that they have, to just even in general Sky Harbor and Fiberfast Homes and Dreamfinders Homes. They have an incredibly good investing track record, and so long as that continues into the future, I think Boston Omaha is an incredibly interesting company to look into. And hey, if you enjoyed this video, we talked about this live. Come hang out. Also, subscribe and like the video. And I think that's going to do it for me today. I did not get to the S&P 500 balance or the big Fed news, but we did talk about some interesting stuff. Let's see what the big winners are. Wave Life Sciences. Oh, look, it's all a bunch of junky biotech companies. And Air Products, tragic. The top gainers and losers is always so funny. You can always tell when it's a boring market day when the top gainers and top losers are all a bunch of biotech companies. Oh yeah, this random biotech company just blew up today. They failed phase 3 trials or whatever. Oh, this random biotech company, they passed phase 3 trials and now they're gonna make $1 trillion in the next 3 years. But anyway, I just saw DSCF. Well, not Discipline. It's not Discipline anymore, but anyway. Yeah. Thanks so much for hanging out. I appreciate it. I will be back probably Wednesday morning, assuming, hopefully with some updates and some of the stuff that we talked about today. Also, hey, if you don't know, I got a YouTube channel. I upload a lot of stuff over there. There's some great shorts over there. Some hilarious stuff, I think. You should go check it out. But that's it for me right now. Thanks everyone so much for hanging out.